All right, Bulls and Bears, we're back with another dose of economic reality. Let's start with the stock market. We got a lot of other news to get caught up on today. We're going to get into the housing market, inflation, what lies ahead of us here, what could bring this market down, what could bring the economy down into correction territory. We're going to cover it all today. Let's go ahead and get started right here. The stock markets sold off today, today being um, August 7th, 2024. Dow Jones down 234 points. That was 0.6%. The biggest drop today was the Russell 2000, though. Folks, that was down by 1.4%. So, this big sell off that we saw on Monday, August 5th, we did see a slight recovery yesterday on Tuesday, but today back in the red. So, we're not regaining the losses that we saw on Monday. So, to me, this looks like the start of a downtrend, right? We may see some green days, we may see some big volatility, ups and downs, but when you start seeing the downtrend, you see big sell-offs followed by recoveries that don't get back to where they were before the sell-off began. Now, if we just look at Monday as the beginning of the sell-off, we're going to track it from here. But to me, it looks like it's going to be the beginning of a downtrend. It doesn't mean there's going to be. It doesn't mean that there's not going to be more big green days. We could see 1,000 point sell-off followed by a 900 point gain the next day. That's typically what happens before markets hit the turmoil phase. And do I think that the next 3 months, the next 5.5 months left in the year, almost 6 months? No, I'm sorry. This is August. A little less than 5 months left in the year now that we're in August. I think this last 5 months or so, it's going to be a life changing situation for a lot of people. Typically, if you look back at history, big things happen as we enter economic downturns and recessions. Now, many would say that this is planned to cover it up, that they'll take you to war to cover it up because that justifies the spending. And that way they can get the scapegoat out there. Oh, look, the economy was fine, just like the central bankers were saying, until the war broke out, right? And many people will just buy that, they'll just believe it. But if you've been tracking the data and if you've been watching the debt situation, looking at all the numbers, you know better and you're not fooled. I'm not fooled, you're not fooled. Let's go ahead and get into some other data here. Let's start with this here. China. China's economy is slowing down. We've got consumer giants like Starbucks and General Mills having sales problems in China. And yes, China is part of the BRICS alliance, one of the BRICS nations, saying they're going to go back to a sound currency. I'll believe that when I see it. But even a fiat currency in place right now, they're not able to keep the consumers spending like they used to. And we're seeing this around the globe. We're seeing it especially here in the United States with a big slowdown as people get either maxed out on their credit cards or close to being maxed out. And many people right now, over half the middle class, having trouble just making the minimum payment. And we're seeing this balance transfer game where we see a ton of balance transfers happening right now. Introductory rate for a year, maybe 18 months, and they transfer to a different place. But more and more people, it's starting to stack up. More and more people not paying off their credit card balances every month. So that's a sign of severe distress. And yes, the top 10% that own most of the stocks, they can keep the stock market looking good for a while, but eventually, when there's no more buyers, when people start panic selling or panic withdrawing their 401ks, now at this point, you're going to pay a big penalty if you take your 401k out. But even with that, over the last year, we see record amounts of people panicking and taking funds out of their 401k. Eurozone inflation rises to 2.6% in July, above expectations. You've got to look at the rest of the world to figure out what's going on. It's not just the U.S. Many people think it's just the U.S. They think it's a leadership problem. They think that Grandpa Joe caused all this. He didn't help it, that's for sure. And I think he had a role in it, or his policies, anyways. But to say this is just a U.S. problem because of leadership here in the U.S., you're blind. You've got to look at the globe. This is a central bank planned operation the whole time to create easy money situation, rock bottom interest rates that we saw for 10 plus years, give the banks the green light to loan out money. No matter how many loans are out there, they're going to continue to loan out more money. We have a zero reserve requirement since 2020, and that's unprecedented, folks. Nobody talks about that. That was put in 2020 as an emergency measure to keep finances going, to keep money flowing, to keep lending going, while the economy was basically shut down and frozen. Why is it in place right now? If the economy's strong, like we're being told, right? The consumer's resilient, the economy's strong, the jobs numbers are great, which they're not, but that's what they were telling us for the longest time. Inflation's transitory, nothing to worry about. If all that were true, why do we have to have the emergency bank reserve still in place here for 4+ years after the health crisis, right? You let me know. Please let me know the answer down that in comments. Nobody's told me yet anything that makes any sense, anyways. Let's talk about home prices here, specifically Las Vegas here. Southern Las Vegas, or I'm sorry, Southern Nevada, which includes Las Vegas, the median home price, folks, 480,000. And don't get me wrong, I love Vegas. I love Vegas. In the summertime, not so much. But when I go there, it's usually from October to March, right? The cooler months. I don't go there a lot, but when I go there, I like it. And 480,000 though, folks, for that for Las Vegas, that's the median price. That's the median price. Setting records, folks, not just setting temperature records, but folks, this is California prices. You could have bought a home in California, even here in San Diego, what, 7, 8 years ago for that. So right now they're paying for homes in Las Vegas. Right now they're paying what California prices were about 7 to 8 years ago, maybe even 6 years ago. I'd have to look back at the median home price. It's pretty insane though when you think about it, folks. And that's the name of the game, folks. They don't want housing to drop. You notice that mortgage rates dropped when markets started selling off. They're trying to balance this out with more easy money, giving people the opportunity to borrow money at lower rates to buy homes. We are seeing a slowdown now in investor purchases of real estate. And if you look at some states, including California, about half of the homes here are sold to investors, right? It's pretty crazy, pretty insane. We've got the home ownership rate here, what, at about 50%, meaning only 50% of people own their homes. And of that 50%, the other 50% are investors and big investment firms, hedge funds, etc. Just think Blackstone. Of the 50% that owns their home, they don't really own it because about 75% of those 50% are under a mortgage, right? So it's still money for the banks either way. Let's move on here. We've got Dell making an announcement here. We talked about this last week, but we didn't know the number. We knew it was going to be kind of big. Dell to lay off 12,500 workers to focus on AI products and services. And this is not the first round of layoffs, folks. Now, to me, I think AI, yes, I think it's overhyped. Is it real? Of course. Yeah, more companies want to go to AI. They want to eliminate the human workforce um, to help their bottom line. They don't want as many people on the payrolls. But to say that AI is the reason for these layoffs, I don't think so. I think they're trying to use that to cover up the big economic slowdown that we're seeing, not just in the U.S., but globally because of the debt levels, folks. People are loaded up on debt, and they're either at their limit or getting close to the limit here. Household debt delinquencies collections here. I wanted to bring up a chart here for you out of Wolf Street here. Look at this chart, folks. This is the debt here. Here is the peak, though, from the financial crisis, 2008. We peaked out at just under $13 trillion. Now we're approaching $18 trillion total household debt, aka consumer debt. But what happened after the crash or after the onset of the financial crisis? We saw debt decrease. That's what's supposed to happen. Debt is supposed to decrease. Of course, you have people filing bankruptcies and charging off debt. There's a lot of ingredients. But, folks, we're not seeing that now. And the big difference is what banks are doing now versus what they did back then. Banks are not afraid to loan out money now. They've been guaranteed endless life support. Back then, banks weren't sure at the beginning of the health crisis, 2008, they weren't sure if they were going to get rescued. Ever since then, they found out, and that's why we saw the debt levels go back to where no one would have guessed this. After the financial crisis, no one would have imagined that we would be where we are today with home prices way above where we were back then. Back then, it was a housing bubble of unprecedented proportions. People thought it was insane what happened to home prices back then. And now, makes back then look like a bargain bin sale at Walmart, right? The housing bubble back then now looks like a rummage sale. with the prices that were at the peak back then. The prices that people thought were insane back then, completely unsustainable back then. Now it's like a rummage sale or a pick your sale there, a thrift store. It's a thrift store type of sale now. And back then it was insane what home prices were. But this is what happens when you have banks that are completely unleashed from any sort of economic reality and from any sort of um, responsibility to loan out money in a way that they know is going to be paid back by the consumers. There has to be an ability to pay it back amongst the consumers. Well, not anymore. There should be. Let's talk about Big Lots. Big Lots closing a lot of stores, including several here in Southern California. But it's over 300 stores now. We did report on that, but I thought I'd give you an update because the number got bigger. And I believe that's a Big Lots store that they're showing right there. Big Lots closing all Tucson locations. Yeah, and many other cities are seeing Big Lots go ahead and shut down here. Of course, they're blaming it on online shopping, but when you look at the reality of that, Amazon, which is the biggest online retailer, has been around for 20 plus years. So to blame this on online shopping, it's, folks, if you believe that, don't believe that. Um, Hotel rooms in New York are averaging over $300 a night, as many hotels exclusively now house migrants. Right? I'm not making this up, folks. About 1 in 5 hotels now in New York are filled up by migrants. So it's causing the prices for the hotels that aren't occupied to go up because there's less of a supply now. And you think that's just limited to hotels? No, it's also happening in the rental market, in the housing market. It's pretty simple to figure out, folks. Supply and demand. When you have millions of people taking up a lot of the supply, then it's going to be less to choose from, and prices are going to go up, folks. Let's talk about this here in the stock market sell-off. The sell-off that we saw Monday, $6.4 trillion wipeout. Well, actually started before that when you look at the tech companies selling off. We've been on top of a few of the trades here, a few of the ways to make money on this. Another big day today for the stocks that we were betting against. NVIDIA and Rivian both dropped today, so our positions got even bigger. I think we're up 70% right now in the Rivian trade since we almost hit the peak. We bought that one at the peak or shorted that via put option at the peak of that. Let's look at this here. USA Today is trying to blame what's happening right now, which I think is a recession, but they've changed the numbers. They changed the definition of a recession. They're trying to say, could we talk ourselves into a recession? So what they could say is, well, the economy was fine, but it was all this fear and all this people talking about how the economy was bad that actually made it happen. In other words, they're trying to blame it on a self-fulfilling prophecy, or they're putting it out there that if a recession does happen, it will be a self-fulfilling prophecy. Nothing wrong with thinking positive, but if you're not looking at the data, if you're not looking at the debt levels, if you're not looking at the delinquencies, then you're not looking at economic reality, folks. So what do you think about all this? We're going to talk ourselves into a recession. Will that be the excuse for the economic downturn? They'll say, well, people talked about it and put out this fear mongering videos like this. You're going to say it was this fear mongering that caused the recession, or nukes are going to fly. Is it going to be World War III? Are we going to start drafting people in the U.S.? We saw what came out a couple months ago about the selective service and how they want to make it easier to draft people. It was just talk, but why would they even be talking about it if there wasn't some motive or reality behind that, folks? So all I'm saying is fasten your seatbelts, folks. It's going to get even crazier, and we're going to be on top of it for you. Make sure you are subscribed. Come back for more updates. Keep stacking. Bye for now. Peace.